Scalping is a very fast style of trading. It is one of the quickest methods used in financial markets today. Traders who use this strategy are called scalpers. They aim to make small profits from many trades throughout the day. Instead of waiting for a big price move over hours or days, scalpers look for tiny fluctuations in price. They enter and exit positions within minutes or even seconds. This approach requires intense focus and quick decision-making. The main idea is that small, consistent wins can add up to a significant amount by the end of the trading session. It is a game of speed and volume, not size. Understanding scalping means thinking about trading in very short time frames. Imagine a large river. A long-term investor might wait for the river to change its course over many years. A swing trader might watch the tides change over a few days. A scalper, however, is interested in the small ripples on the water's surface. These ripples happen constantly and offer brief opportunities. Scalpers use advanced charting tools and technical analysis to spot these fleeting chances. They must be ready to act instantly without hesitation. This strategy is not about predicting the long-term direction of an asset. It is about capitalizing on the immediate, small-scale volatility that exists in every market. The term scalping itself gives a good clue about the strategy. It suggests taking just a small piece from the top, like skimming a tiny profit off a larger price movement. Scalpers are not greedy. They are happy with collecting a few pips or ticks from each trade. A pip is the smallest price change in the Forex market, while a tick is the smallest price change in the stock market. Because the profit on each individual trade is very small, scalpers must execute a large number of trades to make their efforts worthwhile. This high frequency of trading is a defining characteristic of the scalping method and separates it from other short-term strategies like day trading. This trading style is most common in markets with high liquidity and tight spreads, such as major currency pairs or large cap stocks. High liquidity means that there are always many buyers and sellers available. This ensures that a trader can enter and exit a position almost instantly at a fair price. A tight spread, which is the small difference between the buying and selling price, is also crucial. Since scalpers aim for very small profits, a wide spread could easily wipe out any potential gain. Therefore, choosing the right market and the right financial instrument is a critical first step for anyone wanting to become a successful scalper in the fast-paced world of trading. The process of a scalping trade happens very quickly, but it follows a clear set of steps. First, the scalper must identify a potential trading opportunity. This is usually done by analyzing very short-term charts, such as the 1-minute or 5-minute charts. They look for specific patterns or signals from technical indicators that suggest a small price move is about to happen. For example, they might see a stock's price touch a key support level and bounce off it. This could be a signal to buy, expecting a very small and quick rise in price. The setup must be clear and meet the trader's predefined rules for entry. Once a setup is identified, the next step is execution. This must be done without any delay. The scalper places an order to enter the market, either buying or selling the asset. Because speed is so important, many scalpers use direct access brokers and advanced trading platforms that offer one-click order execution. After entering the trade, the scalper immediately sets a target price for exiting with a profit. This target is very close to the entry price. At the same time, they also set a stop-loss order. A stop-loss is an order to automatically close the trade if the price moves against them by a certain small amount. The third step is monitoring the trade, but this happens in a flash. A scalping trade might only last for a few minutes, or sometimes just a few seconds. The trader watches the price action intensely, ready to exit the moment their small profit target is reached. There is no waiting around to see if the price will go even higher. The goal is to get in, take the planned small profit, and get out. This discipline is essential. Greed has no place in scalping. Trying to squeeze more profit out of a single trade goes against the core philosophy of the strategy and often leads to losses when the market quickly reverses. Finally, the trade is closed. This happens in one of two ways. Either the price hits the profit target or it hits the stop loss. In either case, the position is closed and the outcome is realized. The scalper then immediately begins looking for the next opportunity. The cycle repeats itself over and over throughout the trading day. A successful scalper might make dozens or even hundreds of these small trades in a single session. The key is that the small profits from the winning trades are greater than the small losses from the losing trades, resulting in a net profit at the end of the day. The primary goal of scalping is to accumulate wealth through a high volume of small, consistent profits. Unlike other trading styles that seek large gains from a few trades, scalping focuses on quantity. The main objective is to exploit the minor price gaps created by order flows and bid-ask spreads. By repeatedly capturing these tiny profits, a scalper aims to build a substantial daily income. This objective requires a mindset focused on probability and consistency, rather than on hitting a home run with a single trade. The success of a scalper is not measured by the size of any one win, but by the positive net result of all their trades combined over time. One of the most attractive benefits of scalping is the potential for quick profits. Traders do not have to hold their positions overnight, or even for more than a few minutes. This significantly reduces the risk of being exposed to unexpected market news or events that can cause large price swings. As soon as a trade is closed, the profit or loss is realized, and the capital is freed up for the next opportunity. This rapid turnover can be very appealing, as it provides instant feedback and gratification. Seeing profits, even small ones, appear in your account multiple times a day can be a powerful motivator for disciplined traders. Another major advantage is the inherently low risk per trade. Because scalpers aim for very small profits, they also use very tight stop losses. This means that if a trade goes against them, the potential loss is limited to a very small, manageable amount. The risk-to-reward ratio on a single trade might be 1-to-1 or even less, but the strategy relies on a high win rate. By cutting losses quickly, a scalper protects their capital from significant damage. This disciplined approach to risk management is fundamental to long-term survival and success in scalping, as one large loss could wipe out the gains from many successful small trades. Let's consider a simple example. A Forex scalper might notice that the EUR-USD currency pair is trading in a tight range. They decide to buy at 1.0850, setting a profit target just 5 pips higher at 1.0855. They also place a stop loss 5 pips below at 1.0845. Within 2 minutes, the price ticks up to 1.0855. The trader's platform automatically closes the trade, securing a 5-pip profit. The trader immediately starts scanning the charts for another similar setup. While this single trade might only yield a small amount of money, repeating this process successfully 20 or 30 times in a day can lead to a respectable total profit. Despite its benefits, scalping comes with significant challenges and is not suitable for every trader. The first major hurdle is the high level of stress and the need for intense concentration. Scalpers must remain glued to their screens for hours, making split-second decisions without emotional interference. The fast-paced nature of this strategy can be mentally exhausting. A moment of distraction could lead to a missed opportunity or a costly mistake. Traders must be able to handle the pressure of managing multiple trades and constant market noise. This psychological resilience is a trait that not everyone possesses, making it a difficult style to master. Another significant challenge is the cost of trading. Because scalpers execute a very high number of trades, transaction costs like commissions and spreads can quickly add up. These costs eat directly into the small profits of each trade. Therefore, a scalper must find a broker that offers very low commissions and extremely tight spreads. Even a small difference in spread can be the deciding factor between a profitable and a losing scalping strategy. Traders must carefully calculate their trading costs to ensure that their strategy remains viable after all fees are accounted for. This makes broker selection more critical for scalpers than for any other type of trader. Furthermore, scalping requires a deep understanding of market microstructure and a robust technological setup. A fast and reliable internet connection is non-negotiable, as any lag can be disastrous. Similarly, a powerful computer and a professional-grade trading platform are essential tools for executing trades with the necessary speed and precision. Scalpers often rely on level 2 data, which shows the order book of buyers and sellers to gauge market sentiment in real time. Mastering the skill of reading the tape and understanding order flow takes considerable time, practice, and a dedication to learning the finer points of market dynamics. In conclusion, scalping can be a highly profitable trading strategy, but it is a demanding pursuit reserved for a specific type of trader. It is best suited for individuals who are highly disciplined, decisive, and can thrive in a high-pressure environment. It is not for the faint of heart, the easily distracted, or the trader looking for a relaxed part-time approach. Beginners are often advised to start with slower trading styles, like swing trading, to gain experience before attempting the high-speed world of scalping. Ultimately, success in scalping depends on having the right temperament, the right tools, and an unwavering commitment to a strict trading plan.